that's when you say, then we're just foreclosing on you, and we're gonna, sell the house. If they're, I mean, what's the interest rate on this? To say
6.5.
I mean, I'd bring this down to 5%, or 4.5%, and let them pay. But it's all about how much the borrower wants to work with you. If the borrower doesn't want to work with you, and they're going to be a jerk about it, then I'm foreclosing on you and I'm kicking you out of your house.
The other thing too is, if you can get them performing at this low of a dollar amount, and they perform for 12 months, you can turn them over to like groups that help restore credit. Get their credit restored, and then convince them to go refinance.
Yeah.
Because remember, we bought, let's say, what was the debt on this? You guys have the $81,000, and we're buying this, let's say, for $60,000. There's a $21,000 difference. After a year of performing, if you can get them to refinance that house, they still owe you $80,000. And that's where the big money comes in. Is you can actually, if you can get them to refinance and pay your note off, offer them a $5,000, I'll reduce your payoff by $5,000 if you refinance it. So there's some other nuances to this that can bring in nice chunks of change with the right borrowers, but you won't know that till you own the note and start working with them, if they're that type of people. How much other trouble are they in credit-wise? But if you can restore that credit and get them to refinance your note,
What's the fair market value of the property?
Michigan City?
around 83,000.
And they owe how much on it?
They owe
Almost the same amount.
81.5. So
Oh,
they
maybe
owe,
that's why I discounted this one. I was looking at ones that had more equity in it.
Yeah.
I think I pulled this off the list because I looked at one of the ones that had a little more equity.
Right.
So.
but this one here, you're buying it. If we buy it, we're going to be buying it somewhere about, like you said, about 60%
Yeah.
of its market value. So it's still 40% equity available in that property.
Right, from what we paid for.
Yeah.
Correct.
Okay. Because
Or 40% discount.
Not around here.
I got it. I'm just saying that I was just looking for sort of rule of thumb. I mean, some of them were underwater by 20%, but I saw even
Yeah.
when I got to a list of
Yeah, but you're basing the bid on the current market.
The bid is based on the value of the property, not the value of the note.
right, and the note was the value of the property. Oh, the bid is based on.
Doesn't
the
matter
value.
what the
Okay.
principal amount
Yeah.
is.
Right. It's
Because most people are never going to pay off their principal balance.
Yeah.
You know what I mean?
Right.
They don't have the money. If they did, they'd be paying their note.
You know-
Unless they win the lotto, and then we're really screwed, because we're not even screwed on this, we lose $2,000 or whatever. Well, we wouldn't, because we'd be buying it at a discount, but,
the thing would
Pay
be is,
off and-
the easiest way to look at it from that standpoint on a note, it's not performing, you get it performing. But if you get them to refinance, they owe you that amount. If you have $120,000 worth of debt, and the house is worth $100, and you paid $60 for it, you could actually go to them a year later and say, you know what? If you could refinance and close my note out, I'll set your payoff at $90,000. You just invested $60, you just picked up $30,000 on your $60,000 investment. You
Plus
just
the-
wiped out
plus the money you got. For the
The
year.
plus the year return on your investment. So you could have a 40% return on that type of a deal.
I got it. I was just drawing too hard of a line. I thought I wanted only properties that had equity of the fair market value. That the loan was less than the
See,
market
actually, the
value.
beauty of this sometimes is you get better deals when the loan is so greater than the value. of
Okay,
the
well, I
property.
mean, I
Yeah.
just tweaked my numbers and searched differently. That's
Yeah.
Awesome.
Yeah. So the payoff thing, getting them to close out your note, is a rare situation.
Right.
But it can't exist. But you can discount their payoff at such a level that you put money in your pocket and you provide them a huge benefit, because a bank would never do that.
Now, would we use that up front as part of a negotiation at all, of just saying, hey, here's my plan, that'll get you back on track, and then, whatever?
It's really, once you find out how they're paying and once you get them reperforming, you could then actually send an offer out to them and get them thinking. If you could refinance my note, I'll give you, by this point, your payoff will only be this. I'll forgive $30,000 of debt on your note alone.
But by the way, there's no right and wrong in any of this, right?
Mhm.
There might be something that I don't see that you see, right? I want you to challenge me. That's the whole thing about being in this group, is we all want to work together. I don't want to work one-on-one with everybody. I mean, a big thing that we haven't done yet is, you know, somebody, Nancy had brought up putting together a forum, right? I want to put together a forum, and I could actually do it on our website. So that might be part of the privacy protected thing, but I want everybody talking to each other.
Sure.
That's the whole thing about being in a group.
So you may have already answered this, and I'm
Sure.
sorry if I missed it, but when you place your bids, if the fair market value is under the unpaid balance, then you're gonna place your bid off of the fair market value, but if your unpaid balance is below the fair market value, wouldn't you bid on the unpaid balance? Why?
Because these days, again, you would on the lower end stuff, right? But these days it's so hard to find the higher end stuff. When I say higher end, I mean $70,000 to $100,000.
Okay.
That sellers are basically demanding that because they know that even if the principal balance is below, for instance, this is an $83,000 house, right? The principal, let's say the principal balance was $70,000, not $81,000,
Okay.
right?
Yeah.
The person in that house is not, the chances of them paying you off 100% of that $70,000 in the next 2 to 3 years is minimal. I mean, less than 5%. I mean, you know, they have to come in some type of inheritance, right? So people don't focus on that. They focus on trying to get the note ready or get it foreclosed, right? There's some people that if the note's not performing, they go right in for a foreclosure. That's the rehabbers. They don't even modify, right? They just want to take control of the house. And that's a lot of people out there right now. But if you want to modify, you're not going to be holding this note, you know, for the whole payoff. You're not going to hold it for the next 10 years. If you could if people pay, but chances are you're not. You just want to get in for 2-3 years, get the payments, and get out. So that's why they know that that's what most investors are going to do. So they don't focus on the UPV as a price. Now on performing notes, that's all you focus on is the UPV because they're performing. So you know that they're paying and they're going to pay off.
Right.
But rule of thumb, like an investor, you don't want to pay more than 70% of the value of the property. You need that 30% of the value of the property to protect you. If
You're talking about performing notes?
any type of note. You don't want to, because if you get less than 30, if you pay more than 70% of the value of the property, and you got to take it over, your principal's at risk. So you're not going to pay full
Are you
market.
talking about performing or not?
It doesn't matter.
It actually does because on performing, right?
Yeah.
It depends on the principal balance on the note, right? So if the principal balance, let's say there's an $80,000 house.
Use the board.
Oh, okay. Yeah, I have the
Good
market.
idea.
You've got the board, he put it there just for you.
So this is just for performing, right? So performing, right? Let's say the house is worth $80,000, 80K, and there's value. That's bad. And the principal balance is only 30,000 left, right? You could pay, and most sellers will charge you for that type of note. They'll charge you between 75 and 80% of principal balance, right?
Right.
So 80% of 30,000 is 80%, or 80%.
So like 4,000.
30 is 26, right?
26,000.
It's 20,
24.
24.
You said it right the first time.
That's how I know we went to Georgetown. So anyways, so it's 24,000, right? So in this scenario, right, if the house is worth 80,000 and you're getting it for 24,000, your yield is probably going to be 14. Your yield is going to be, wow, I'm really messy. It's going to be 14%, most likely, somewhere around there, based upon the monthly payments and stuff, right? This is probably one of the safer investments that you'll ever see because you have it at 24K, right? And in this scenario, I'd want this guy to default, right, on his first, because then I'm going to foreclose right away.
Take it.
And some of the notes that we have are pretty close to this. I mean, a little bit less. Some of the performing notes that we bought, the last two that we bought, you know, we bought one for 42,000 and the value is 86,000 on the house, and we're yielding what, 14% on that around?
Yes.
And then the other one was somewhat similar too, right?
Yeah, there was a ton of equity in both of those.
Yeah, so the loan to values were over 50%, you know, loan, it was like 50% loan to value. So I want this to happen, that's where I will pay 80% of the principal balance, right? Not of the property of the house.
So you would foreclose, you would get your $30,000 back on 24, and he would get the balance?
No,
Is that really?
No,
no. I would
Yeah.
foreclose and take over the property and sell it. Or,
and it depends on the state. If you're required to auction, if let's say you actually auctioned the property off and it went for 50, we get our 30.
yeah,
But if nobody bids on it, or if somebody comes in and there's the highest bid, we set a reserve at 30 because that's what they owe. We're the bank, we're setting the foreclosure, we set the reserve price on the bid, all the way to our total debt. So in that case,
Above your total debt?
Can't go
No.
above.
you
But
cannot
if
go
it's-
above your total debt.
But if it's worth 80, why wouldn't somebody buy it?
That's
But
what
you
they
could
would.
you could be bidding on it though.
And as a bank, we can bid on it too. Remember, we could go in and bid on this property and somebody's bidding 32, the bank could bid 35. The other person bids 37, we bid 40, and everybody else stops bidding. Well, we already owe 30. Our bid was 40, we only need to come up with 10,000 more and we got an $80,000 house.
Okay.
So it doesn't exclude us from still being a bidder in the process, but we know where the bottom line is.
In this case where it's performing, it's $80,000 value, principal balance on the loan is $30,000. What seller is gonna sell it for 80% of that? Wouldn't they sell it for 50-60% of the,
no, because these are all reperforming notes.
these are
So
reperforming?
Yeah, there's a risk, there's an
Okay, there
inherent
is a
risk in
risk,
it.
okay.
And the trick on this too is, this is a prime candidate with this value, if they, to where you work out, convince them, send them a letter to refinance. You pull out the 6,000 in profit immediately, and you move on to your next investment. So it depends on what you're looking, long-term 14%, or hold this for a couple years, get them to refinance, and take the top and go back into another note. Because it's the first couple years of every note is where it's all interest.
Now, I just sold a note to an investor that was 13,000 principal balance. Now, that investor will probably get payments for the next year, maybe 2 years, and then the balance can be down to 4,000. That person, that house is just gonna be like, I'll go get a loan and pay off the 4,000 if they can. So that's the end of it. But this is what happens when you're dealing with such low value houses is, money that's doesn't make sense. Like, why wouldn't somebody just pay off a $13,000 mortgage? Well, there's a lot of people in this country that don't have $1,000.
Yeah, they don't.
Actually, it's a proven fact that 70% of this country has less than $1,000 in savings.
70%?
70%. And you can look that up online.
Now, the only thing what I was saying is, if this note was closer to the 80,000, my stop point is, at wherever it is, I'm not gonna pay more than 70% of what I think the value of the property is.
56,000.
So that would be the most I'd ever, this could be $150,000 worth of debt. I'm gonna go back in 56,000 at the 70 mark, because I need that 30% spread to cover my foreclosure costs and getting it back on the market and paying a realtor to sell it.
You're saying that's regardless of whether it's
I will not, what it is the 80% here is based off the debt. There's a second number, and it's 70% of the value of the
Because the
property.
brains are working.
You gotta give yourself that 30% window to protect your principal.
There's a dozen 98.6 heaters in here.
So I'm after
Yeah,
protecting
you
the
gotta put
principal.
an air conditioning in here.
Yeah, really.
I don't control the building.
I get it. So anyways, the only thing that I would pay 70% for is a non-performing note in an area where the value of the house is appreciating by 10% or more a year. So there are parts of Southern California right now that people are paying regularly 80% of value on the note if it's a non-performing note, and that's usually on houses that are. I mean, those are hedge funds. They're buying, Blackstone owns half of California and half of Arizona right now because they bought up notes by the thousands kind
Okay,
of stuff.
folks, it's going on about 10 minutes to 5, so we got through a lot.
Yeah.
Maybe we wrap it up. How'd you like this format?
Good.
Not as pressured as the library situation, the rush. So
Yeah, library's okay.
we figured this
Well,
was
this is
Right.
all fall back.
We'll go to
Having
the
it.
library
That's
if you
nice.
go to
That's-
Virginia.
That's
That's
nice.
nice.
Yeah.
all right. We just, you know, this was a nice block of time. We had a nice rainy day. Couldn't do much else, so we really appreciate you guys coming out.
What was the other note you put a bid on? That was
Did I tell everybody
You
that-
didn't tell us, what, you did tell us what you
Did I tell everybody it's $3 for the water and just to give it to me?
Yeah.
Yeah, which ones did you bid on and how much?
So we bid on the Michigan, Indiana one for $47,600. And then a note that's not actually on this list, I don't see it.
Oh, okay.
Yeah.
Missouri, St. Louis, Missouri, right? That's it, right there.
Yeah.
We-
Park Lane.
Yeah, Park Lane, we bid $25,000 on that.
All right.
And their value is 55,000. We had that pegged at the mid-40s.
Did you say 25,000?
Yes.
Yeah. Now, their value is much higher, so we're below the 50% of what they think
My
the
family
value
lives in
is.
St. Louis,
But
you'll
you have
have
a
to ride
reason.
by.
But we
Yeah.
have a reason
That's
because
good.
we don't
I
think the
know,
property
I
value's
can
there.
have to go just
There were
eyeball
some
it.
higher priced properties.
His family lives in St. Louis. They could do a drive of it.
Great.
Could,
Yeah,
you
my
think
brother, either one of them probably could do it.
could they take a picture of the house?
Sure they could.
That would save us $50. I mean,
Yeah. Could you ask them? Shoot them the address and
The picture on
Yeah.
Google was from.
We'll see where it is. I mean,
was it?
It
From
is.
14, I think.
Was it really?
I think I saw that when I was just on.
No.
Pull it.
when you pull up the Google,
Well-
it'll have the current date.
Why don't you
Oh,
pull,
You
is that
gotta
what it
look
was?
where the
Uh-oh.
photo date
why don't you
was.
pull up the picture? That'll be the last thing we do, just so we could show you what it looks
Yeah, I
like.
wanna see where it is in the city. I wanna see
Yeah.
where,
Oh,
what
St.
part
When
it's
you,
in.
when you hear
That's a
on
nice
the
little
bed.
house.
We'll
I got
hear
the other one
Monday,
I
Tuesday.
noticed this
And
summer.
then what are the next, like, what do you do in
I
that
didn't
next
see that
48
one.
hours?
So what we will do is we will send the collateral package out to everybody in the group. We're talking about bids that are accepted on these two notes. If the bid is accepted on these two notes, we will send out the collateral and we will send out the O&E reports on both of them once we order them. And I will go over both of them and I will tell you what I looked for and what I didn't look for. And Ken and I will do that. And
That's okay, you do it all.
pull that out.
Let me first show you the area.
Wait. Ken, go back down.
Jennings.
Yeah, it's a nice
So that's
neighborhood.
North St. Louis.
That's
Real
North
nice
St.
neighborhood.
Louis.
Yeah.
Well,
As long
North
as it's
St.
not
Louis
East
is.
St. Louis.
Goes
like,
both ways.
it goes way both ways, yeah.
Yeah.
The East St. Louis is
Now,
bad?
this,
Oh, this one.
I think I ruled it out because of the value.
Yeah,
So-
those brick homes.
Yeah, so this is, well,
Yeah.
let me just show it to everybody. So the reason, this is it right there, right? Again, everything, they have bushes up, the lawn's been groomed, no garbage anywhere. Brick house, you know that it won't fall over unless there's, a hurricane or something.
Roof looks decent.
The roof looks decent. And I like this because the houses around it are all brick.
In this house.
Now, remember, I told you, look at the back car, right? This is a recent, October 2011, right? So they have a brand new Jeep back there, right? That means that they had money at the time, or I don't know, maybe they're doing something. I don't know what they're doing.
it's up on blocks, but it's,
Or maybe they stole it the day before. Who knows?
that's a chop shop.
Yeah, that's a chop shop. But again, there's no garbage. It looks, there's sprinklers right there. They're taking care of their house.
If you scroll the neighborhood, I mean, look at this community. It's a nice looking community. This is the one Ian and I talked a lot on, because there are some prices in the higher range, but there's also a certain number of distressed properties that will
Yeah.
foreclosures,
Oh, thank you.
take backs and things. So it kind of screws with their numbers. That's why we're below their price 50%.
Oh, it's log off, yeah.
And you say the resale value was
Is that it?
what was your value?
It's right
Peanut
now,
butter
it's
cookies.
yes, somewhere around the 40 to, between the 40 to 45 range.
I stopped
And what do they
outside.
claim it is?
58.
Donna's got a quarter pack.